Welcome back to the next part of our discussion about translation methods. Let us compare the three major translation methods that we have studied together. Current and non-current method is in the first column of this table. Monetary and non-monetary method is on the second column, and all current or current rate method is on the last column. The rows of this table have a balance sheet, so we get an idea of how to translate a balance sheet using each one of these methods, and we get a comparison of their differences. On the asset side, we have short-term financial assets. Then we have long-term financial assets, and then we have real assets or fixed assets. A long-term financial asset would be a share of a stock in another company. A short-term financial asset would be if we loan $100,000 to a company for 1 month. Then we have the liability and owner's equity side of the balance sheet, and of course these two sides are equal. The asset side showed what the corporation has, and the liabilities and owner's equity shows who owns what the corporation has, or this is a liability that someone else has a claim on. Who has claims on our assets, who owns our assets. Here too we have short-term financial liabilities. We had a loan from the bank for 2 months. We have a long-term financial liability. We raised capital from the bond market for 10 years. And we have equity or net worth, the owner's equity, usually consisting of two accounts, what they initially contributed in terms of equity in an initial public offering, purchasing into this private firm that became public. The stockholders paid, and after that, every year that we operated, we retained some of our earnings and we added it to the owner's value in this retained earning account, and these two accounts add up and they give us net worth or equity account. Okay, let's look at short-term financial assets. All the methods agree and they use the current exchange rate for translating the value of a short-term financial asset that the subsidiary has in foreign currency, and they translate it into our domestic currency at this period's exchange rate. Let's look at long-term financial assets. Only the current and non-current method uses the historical exchange rate because these assets are long-term, they're not current assets. But the other two methods, monetary, non-monetary, and all current, uses the current method. In fact, the current exchange rate is always used for the current rate. If you look at the last column, it's very easy. Everything is current except for net worth or equity, which is historical. So the current rate is quite easy for remembering, exam purposes, and in practice it's user friendly. Then we go to real assets. These are buildings, laptops, copier machines, assets that we can touch, tangible assets. They are done at the historical rate, except with our current rate that translates everything at the current rate. Then we go to liabilities and owner's equity. Again, short-term financial liability, similar to short-term financial asset, it's easy. Every method of translation translates it at the current exchange rate for this period. Long-term financial liability. It's the mirror image of long-term financial asset, and the same thing applies. The current non-current method says this is long-term, so it's non-current, and uses the historical exchange rate. Every other method uses the current exchange rate to translate this into uh, uh, our parent's currency. Finally, we get to net worth or equity. Every translation method uses the historical exchange rate to translate the net worth or equity. In other words, if we paid money in 1957 to purchase that factory in Nigeria, the value of Nigerian currency in 1957 against our home currency is what we use under every translation method to translate and report the value of that asset or the equity or ownership interest in that asset. Finally, on the bottom of this table, we have a listing of what happens to gain and losses that are resulting um, from a translation method. These gain and losses are reported in the income statement under two methods: current and non-current, monetary and non-monetary. And that is a shortcoming of those methods. They cause volatility in our profits and losses. But under all current method, the American method currently, um, they do not, these translation gains or losses do not affect our income statement. They do not add to our profit or loss, but they are reported in the balance sheet. In fact, all three methods affect our balance sheet, and they are reported as a separate account, and that account is called accumulated translation adjustment, or a CTA um, account. I better say cumulative uh, translation adjustment, so it abbreviates to CTA. And this word accumulated is used to say that every period they add on top of each other. We had a nice summary. Let's also do the same with a numerical exercise. So in this slide, you would see a classroom example of the balance sheet of a company. And you're going to translate this balance sheet of our subsidiary into our parent's balance sheet using each one of these translation methods. So practically with numbers, you could see how these translations work. So the problem reads: a foreign subsidiary of a US multinational company has the following data. Under the current assets, we have a cash of 300. The units are FC. It's easy, user-friendly to read this FC as foreign currency, and you would hear me sometimes do that. But really, this F stands for functional currency. Okay, so this 300 is in Japanese yen, and we want to make it into US dollars. Let's call it foreign currency, and let's leave it. 300 of foreign currencies are cash. Of course, this could be 300 millions. The units would be also stated in that balance sheet. Then we go to accounts receivable, another current asset, monies that customers owe us because they purchased the product but haven't paid yet. And this is 450 FC units, foreign currency or functional currency. We are holding an inventory of 600 units of foreign currency, and note that this inventory is carried at market price. Therefore, when we go to this temporal method, we are allowed to use current translation. So I'm going to give you an example of temporal method. This is a Harvard Business School lecture note example. I didn't make it up. Then we go to our fixed assets, our long-term assets. We have 750 units of, again, functional currency, or simply call it foreign currency, worth of long-term assets. Then we go to our current or short-term liabilities. All of them are added up. These are usually three different accounts. They're all added up and they are reported in this example as 300 units of FC. Long-term debt, debt for more than a year, raised as capital, 900 FC. And finally, equity or net worth, and this is usually two accounts, owner's equity plus retained earnings. It adds up to 900 units of FC. The problem goes on to say that the historical exchange rate is a dollar equals 2 units of functional currency. And the current exchange rate is parity. A dollar equals 1 unit of functional or foreign currency. That is, the functional currency FC appreciated from 2 FCs per dollar to 1 FCs per dollar. We want to know what happens to our translation and how much losses and gains we would have under each translation method. By the way, notice that different translation methods give us different values, so we get a good place to compare them and see the differences. This problem, which is similar to exam problems that we do and similar to a homework that you would get at the end of this lecture, says translate the accounting data using all of translation methods available. The 4 ones that you studied in this class, so we get a good idea of these lectures. Here is the solution to this problem. It helps if you assume away some of the numbers in these solutions. So let's start by the numbers that they would give us in practice or in an exam. They give us a balance sheet, and here the balance sheet is the first column. Again, it has accounts, and those accounts are cash, and the cash is given in foreign currency or functional currency units of 300. Accounts receivables or simply receivables of 450 units of foreign currency. Inventories of 600, fixed assets of 750. These numbers are added up and the asset side of balance sheet totals to 2,100 functional currency. Then we go to liability and equity side of the balance sheet. There is a current debt of 300, short-term debt. All of the short-term liabilities added up to 300 units of FC. Long-term debt capital is 900 FC, and net worth or equity is another 900 FC. If we added these numbers together, we would get 2,100 FC, and the balance sheet balances, both asset and liability and owner side, are 2,100 FCs as it should. So everything is correct. Now we go to the blank part, the work that you and I should do in practice or in an exam. Of course, the top of this table is also given to us. The problem says that the historical rate was a dollar equal 2 FCs. And the current rate, the exchange rate for this year, is parity. A dollar equals 1 foreign currency. Given these rates, we want to translate the accounting statement, which is a balance sheet of the foreign subsidiary, into our home currency, assuming that we are a dollar-based multinational. We are going to put a bunch of ones and halves in the next column. So assume that everything else from now on, this whole area, is blank. Let me do this way. This is all not there, right? And we are making it up. And we are starting to make this thing up. That's the work that you and I are focused on. So first we go to cash, and we say, look, I'm under current non-current method. Is cash a short-term asset or a long-term asset? Well, cash is a current or short-term asset. Current assets are translated at current exchange rate of parity. So here I need to put a 1, this one. And that one tells me if I multiply 300 units of foreign currency by 1, I would get $300 as a translation of that value. Then I go to accounts receivable and ask the same question. I'm under current non-current method. Is this accounts receivable a short-term asset or a long-term asset? Receivables are short-term. Customers haven't paid us and they have a certain amount of time, for example, 2 months to pay their bills. Therefore, I need the current exchange rate, and I should multiply by 1 to get dollars. I write a 1 here. Then I go to inventories. Same thing. Inventories are a short-term asset, and we use the current exchange rate for short-term asset and multiply by 1. Then I go to fixed assets. I ask myself, are they short-term or long-term? Fixed assets are a long-term asset. They last more than 1 year, for example, a building. And for translating historical exchange rates, I multiply by half because the foreign currency is half price in terms of dollars. 2 foreign currencies buys a dollar. So here I'm dividing 1 by 2 and getting half as my multiplier. Something that you should do if the rate is not 1 to 2, but it's 1 equals 2.5 foreign currency. Then you divide by 1 by 2.5 and get a different multiplier here. Okay, so fixed assets are translated at the historical rate, and historically this currency was half price, so 750 has to be multiplied by half. Then we go here and actually carry on multiplying for half of the balance sheet. It's asset side. 1 times 300 gives us $300. 1 times 450 gives us $450. Note, classroom exercise is easy to keep it tractable to help us in the classroom. And in real world, of course, this would be not as easy as multiplying by 1. 1 times 600 gives us $600. Half of 750 gives us $375. Then we add up all the items in the asset side. This, and that. $300 plus 450 plus 600 plus 375 gives us 1,725. Then we jump to the other end of the balance sheet and we write $1,725 there. I call this cheating for fun. We have this side of balance sheet as 1,725. We know that the balance sheet must balance, so we go and write the other side of the balance sheet as 1,725. Let's put that fun aside. This is one place where a lot of my students make a mistake in the exam time under high pressure. It's something unusual. Adding up these numbers is usual. You get the total for the balance sheet, asset side, then you jump from the asset side to the liability side and write down the same total of 1,725. Then you go to actually translating the other side of the balance sheet, liabilities and owner's equity. We focus first on current debts, current liabilities, and they are all current, short term. We multiply them by 1. Long-term debt, this is non-current, long-term, multiplied by half. Net worth or equity, we always multiply by half for equity, and it's done under every method you're multiplying by half, so that's easy. Of course, you could also say that equity is long-term, so it's non-current, and we multiply by half. Then we go to next step and start to actually multiply. Imagine that these numbers are not there, so you multiply 1 by 300 and you get $300. You multiply half by 900 foreign currency, and half of 900 foreign currency becomes $450. You multiply half by 900 foreign currency and you get $450. Then you start adding up these three numbers. 300 plus 450 plus 450 gives us $1,200. But oops, this side should add up to 1,725. We're only at 1,250. I'm sorry, 1,200. So we are short. We are 525 short. 1,200 subtracted from 1,725 gives us 525. Again, it's fun to say we cheat, but we are short. We write it down as 525, and therefore it balances, because 525 plus 450 plus 450 plus 300 gives us 1,725, and the two sides of the balance sheet balance. Let's go beyond this fun thing that I said we cheat. Really what we are doing is we are saying we have assets that are worth $1,725, and when we look at our liabilities and owner's equity, it is only 1,200. So the additional 525 of assets that we have belongs to the owners, and we add that as a gain that comes because of this translation. So translation would lead to losses or gains under current and non-current. In this example, it gave us a gain of 525, and this gain would also go into our income statement and add up to our profit, and that's something that we complain as in multinational companies about current non-current methodology. Then let's go to monetary non-monetary and systematically do the same exercise. Again, assume that all this area is blank, so we want to put our ones and halves. Cash, is it money or is it non-monetary? It's money, so we use the current exchange rate or multiply by 1, so I write a 1 here. Accounts receivable, this is a contract that says people owe us money, so it's monetary, we put a 1. Inventory, these are physical items that we can touch, like lumber and metal and finished goods sitting in our storage. Because they are not money, they are non-monetary, we multiply it by half. Fixed assets, again, these are physical real assets, we multiply by half, or long-term exchange rate. Then we go to the next step and actually do multiplying. This 1 gets multiplied by that 300 and gives us $300. 1 times 450 gives us $450. Half of 600 gives us $300. Half of 750 gives us 375. So notice that we are ignoring this whole thing. That's the old current non-current method. We're not doing that method anymore. We are doing monetary non-monetary. Okay, so our asset side of balance sheet is $300 plus 450 plus 300 plus 375 adds to $1,425. Notice that this value of assets after translation is different than $1,725 that we would have gotten under current and non-current method. So one problem we have is Different methods give us different asset values. And of course, they affect our profits. We see that in a minute. Again, we take this 1,425 total assets and we write it at the other side of the balance sheet because balance sheet has to balance. So the total of liabilities and owner's equity is also $1,425. Then we go and make up these numbers, translate to get to these numbers. For that, we need a bunch of ones and zeros. Current debt, we ask ourselves, is debt monetary or non-monetary? So according to a contract, it's not a physical asset. Debt is monetary, therefore we have a 1. We translate it at the current exchange rate, which is 1 to 1. Then we go to long-term debt. Again, that's debt. It's monetary, a 1. We go to net worth or equity. Equity is always historical or a half to foreign currencies historically purchased the dollar. Now 1 times 300 gives us $300. 1 times 900 gives us $900. Half of 900 gives us 450. Now we add up these three numbers on the other side of the balance sheet, on the liability and asset side. We get 300 plus 900 is 1,200 plus 450 is 1,650. But it should be 1,425. So the balance sheet balances. Is 225 too much? So we write that in parentheses. Of course, that means we subtract 225, or there is a loss of 225 due to translation. Our owners need to have 225 less money. This 450 that they own would be reduced by 225. Owners are the ones who suffer due to this translation loss. They lose out. And then the two sides of the balance sheet balance. Our assets is 1,425, and when our owners worth only 225, and adding these two numbers, then we can pay our liabilities and have 1,425 at the liability plus equity side of balance sheet. So, in contrast to current non-current method that gave the same company a gain, monetary non-monetary method gives it a loss. Again, unusual volatility, very much dependent on the whim of the regulatory agency, and of course it's something that would hurt the company. This amount, and of course the units could be millions of dollars, goes into income statement and they would have 225 loss in their profit. Next we go to temporal method. Everything is the same as monetary method. All these numbers are the same. All these numbers are the same. So I don't give you a headache. The only thing that is different from monetary method is, I shouldn't say up to here, the only thing that is different is inventory. And here we have a case that the information about the company tells us that they keep inventory at the current cost. Everything is recorded in their inventory system for accounting purposes at current cost. So we are allowed to translate inventory at the current exchange rate, which is parity or 1 to 1. We put a 1 here. The other numbers are the same as we had them on monetary and non-monetary. So we multiply 1 by 300 and get 300, 1 by 450 and get 450, 1, not half, by 600 and we get 600, half by 750, we get 375. We add up the assets that we have in dollars and we end up with 1,725. We jump to the other side of the balance sheet and write the same number, 1,725, as our liabilities and owner's equity. Now the balance sheet balances. Then we go and translate the other side of the balance sheet. Every number is the same as before, so we get the same 300, 900, and 450 we had. We add up these numbers and we get 1650, but it has to add up to 1725. The difference is 75. Here we would have a gain of 75, even though monetary and non-monetary gave us a loss of 225. And of course, that's because inventory was translated at the historical rate. And finally, we go to all current method. Very easy. You just write ones everywhere. So that's easy to do, except for equity or net worth, which is always historical, in this case a half. Then we go and fill up these numbers. Assume here we have blank. In the exam, we would have blank here. You would take 1 and multiply by 300, and you get $300. 1 times 450, $450. 1 times 600, $600. 1 times 750, $750. And on the asset side, you will get exact same number that you had, 2,100, because there is parity here. 2,100 of functional currency translates to $2,100. We write this number also on the other side of balance sheet, 2,100. It should balance. Then 1 times 300 becomes $300. Current exchange rate, 900 multiplied by 1 gives us $900. The only thing that is at historical rate is net worth, and that rate could be achieved by multiplying by half for us. So half of 900 gives us 450. Then we add up these numbers, 300 plus 900, 1,200, plus 450, 1,650, but that's short of 2,100 by 450. So we write this 450, so this balance sheet side also adds up to 2,100. 450 is a gain. Now this gain would be recorded in a CTA account next to the owner's equity in the balance sheet. That's just a matter of naming it, but balance sheet is affected. But fortunately, the income statement stays unaffected. This 450 does not go as a gain or profit for us. And also losses from translation do not go into the income statement. Therefore, the income statement is less volatile under our current translation method. Let's quickly put this discussion into writing, so you have it in writing and you could refer to it. Typical exam or quiz questions too. What would the exchange loss or gain be using the current non-current translation method, giving uh, the numbers that you have seen in this balance sheet? Under current non-current, we had a gain of $525, and you saw the method for calculating it. The next question is, where does this amount go? It goes on the income statement and gets added to the translated foreign income as an exchange gain. In other words, our profit will be affected and will increase by $525. The net worth on the balance sheet increases by this amount also. So both balance sheet and income statement are affected. Next, what would the exchange loss or gain be using the monetary non-monetary translation method? We calculated that um, and we got to $225 of loss. This loss goes on the income statement and gets subtracted from translated foreign income as an exchange loss, we would have less profit to show. It may actually turn our profit to loss if our profit is less than 225. And as I said before, these numbers could be in millions of dollars. The net worth or the value of the company on the balance sheet also goes down by 225. What would the exchange loss or gain be using the temporal translation method, given that inventory is carried at market price or replacement cost? If inventory is not carried at market price, then this temporal method would be exactly the same as monetary and non-monetary method. If inventory is carried at market price, then we can translate it at a historical rate, and we would have a gain, not a loss, a gain of $75. Our profit in the income statement, our net income, will go up by $75, and in the balance sheet, we would have an extra $75 value for the owners. Owners' equity would go up. The income statement goes up by $75. This gets added to the translated foreign income as an exchange gain. The net worth on the balance sheet increases by $75. Finally, what would the exchange loss or gain be using the all current translation method? This additional thing in the parentheses doesn't really matter, it's irrelevant. Sometimes you get an irrelevant thing in the exam just to test if you're paying attention. It says with inventory at the current rate. With the current rate, everything is at the current rate except for owner's equity. We did the calculation, and this would, with the current method, the American method, we get a $450 gain. The gain, of course, goes to the balance sheet, but stays in a different account, so we can clearly identify it as something that is not due to our operations of making products and selling them, but it's a paper gain because we translated the foreign currency into our home currency. That account is called cumulative transaction adjustment. This CT account is important because gives notice to everyone that, hey, this is translation, this is not real side of business. It is not that we sold more cars, it's just their currency value changed against our currency value, and that gave us a gain. There is no effect on translated foreign income. The income statement that is not adjusted by a gain of $450. The net worth, equity plus retained earning on the balance sheet increases by this gain and by this amount of $450. And this gain affects the income statement only after the relevant assets are sold or we sell our foreign subsidiary. At this point, let me close this part of the lecture and leave the rest of it for the next video.